Hi everyone, Tim Vipond here, co-founder and CEO of Corporate Finance Institute. Today I'm going to walk you through how to build a DCF model in Excel. We're going to start with some theory where I'm going to break down the principles of discounted cash flow analysis. Then we'll flip back over to Excel where we'll build it together step by step. Now, this lecture builds step by step over time, so I recommend watching it from start to finish so you don't miss anything along the way. I'll also put a download link to this model in the course notes as well, so please be sure to check those out. So as you can see here on my screen, we've got a discounted cash flow analysis, this section here, where we're going to calculate a company's share price based on our forecast of how it's going to perform in the future. We'll be calculating the company's cash flows, as you can see right here, and then discounting them back to today. If I flip through the model, you can see that it's all driven by assumptions. These are three different cases that we could hypothetically imagine for this business that we want to value, and we can see how they flow through the model to help us calculate its intrinsic value. We can use charts and graphs to represent these different cases and give us a real sense of how the company is going to perform. So, with all that in mind, let's flip over to review some theory on discounted cash flow analysis. All right, let's review what discounted cash flow valuation really is. We're calculating the net present value of the future cash flows of a business. So what we do is we forecast year 1, 2, 3, 4, 5, etc. into the future in our Excel model, and we discount them back to today at a discount rate, typically a company's weighted average cost of capital. And that gives us the net present value of the business, which shows us what it's worth or what we might be willing to pay for it today. As a reminder, discounted cash flow analysis is just one type of valuation. There are three broad categories of valuation, as shown here. On the left, we have the cost approach. In the middle, there's relative valuation, where we look at multiples compared to other companies. And then on the right, we have discounted cash flow analysis or intrinsic value of a company. That's where we're focused today, and that's what I personally find the most interesting and the most detailed when it comes to valuing a company. So there are two parts to a DCF analysis. The first part is stage 1, where we have a discrete forecast. In Excel, we are going to model out revenues, expenses, and cash flows for a company for 5 years. This is a common forecast period, 5 years. And then discount those numbers back to today. Then stage 2 is a terminal value. Since we're not going to build our forecast out for, say, 100 years, it would just be far too much detail. We're going to assume a terminal value that could either be a perpetual growth rate, so it grows into perpetuity at some low growth rate, or an exit multiple assumption, where we assume the business could theoretically be acquired by another company at a certain valuation multiple. And this is the more common approach. So we're going to employ that approach when building this model together. Then we add together stage 1 and stage 2, and we get our total net present value or total DCF. There are a lot of assumptions that go into building a DCF model, and this is why I personally like them and why they're so commonly used, because you really get to paint a complete picture of a business. We will look at everything from the size of a market to sales mix, price volume analysis, costs, balance sheet assumptions, and so on. You could really have an endless number of assumptions that go into your model, or you could keep it simple. And in this case, to make the point in Excel, we're just going to keep it somewhat simple, focused mostly on revenue and operating costs for our model. But when we take all these assumptions together, not only are we able to model the financial statements of the company, but we're able to get the unlevered free cash flow or free cash flow to the firm for the business, which is what we want to use to calculate our DCF analysis. So as a reminder, unlevered free cash flow to the firm means if the company doesn't have any debt, it's before interest payments, then that cash flow is available to all types of investors, debt and equity investors. And that is how we calculate firm value, and that is what we want to focus on here. Now, to calculate unlevered free cash flow, the most common way to do it is to start with EBIT, which is operating profit. Deduct taxes from that, which gives you no PAT, or net operating profit after tax. Then you add back depreciation and amortization, since it's a non-cash expense. Deduct capital expenditures, and deduct the increase in net working capital. The sum of this gives you unlevered free cash flow, or free cash flow to the firm. And this is what we're going to build up together in Excel. When we work through an example together, I think you'll find it clear. And as a recap, let's look at weighted average cost of capital, which will be our discount rate in this model. We have to look at the cost of equity and the cost of debt for the company to calculate the weighted average cost of capital. We're going to use the capital asset pricing model, which assumes a risk-free rate plus a premium for risk. And this combined gives us the discount rate to bring the cash flows back to today. Because as an investor, I need to be compensated not only for the time value of money, for all the years it's going to take to get this cash flow, but also for the risk. I need to be paid, if you will, for the extra risk I'm taking from investing in this company. Now let's look at terminal value and how we would calculate that part of the DCF model. There are two types of terminal values: the perpetual growth method, where you assume the company just grows on forever at some relatively conservative growth rate, or the terminal multiple method, or exit multiple method, where you assume that the company could be acquired for, say, an EBITDA multiple, like 8 times EBITDA, which gives us a lump sum of cash to pay us for the remaining life of the company. So we have our forecast period plus our terminal value to get the total. And when we go over to Excel, we're going to use the XNPV function to calculate the present value. The reason we use XNPV is we can apply specific dates to each of the cash flows that we receive and bring them all back to today. So we're going to go through and link that up together in Excel. And the number that it spits out from this XNPV formula is our DCF value. And if we divide it by the number of shares after we make a couple of calculations along the way, we can get the share price for this business. So let's flip over to Excel and get going at building this DCF model together. All right, so here we are in the Excel file. This is the DCF model that we are going to calculate together. You can see the cover sheet here. We always start our models at CFI with a nice cover sheet like this. And if we scroll through, first we have the Outputs tab. Why is that? Because we like to start with the end, the final presentation of what we're going to create here, and we can see different growth scenarios for this company. And that's all based on different inputs or assumptions. We have assumptions about revenue growth, cost of goods sold, and SG&A expenses. And those flow into the actual model here. If I click on the Model tab, that enable us to forecast an income statement for this business. That flows down into our unlevered free cash flow schedule, as I described earlier in the theory section of this. And then finally, we can calculate the discounted cash flow and the per share equity value of $3.03. So let's go through and build this together. I'm going to remove all the formulas that we need to calculate, and we'll complete it together. And finally, the formula that we're going to use to calculate the net present value is the NPV function in Excel. There's also a more advanced version, the XNPV function, but for the purposes of this course, let's keep it simple and simply use the NPV function in Excel, where we take each cash flow and discount it back to today. So with that said, let's flip over to Excel and start building this DCF model together. All right, so here we are back in the DCF model, and we're going to calculate, the ultimate goal is to calculate this price per share for the business. And in order to do that, we have to fill in the unlevered free cash flow, as I described in the slides earlier, then apply an exit multiple to get a terminal value and discount that all back. So to do that, we have our schedule here to calculate unlevered free cash flow. And it's based on this forecast. You can see here the 5 years of the forecast, 1, 2, 3, 4, 5, and then a terminal value. So to do this, let's link it up in Excel. We start with EBIT, as you'll recall when I outlined that in the slides, which is the same thing as operating profit. We will then multiply that by the tax rate to get the tax expense. And if we add those up, Alt equals is the shortcut. We get the total NOPAT. We can copy this, Control C, and then selecting across Alt ES to paste special as formulas. And we now have our NOPAT for each of the 5 years plus the terminal value. Now what we need to do is add back depreciation and amortization. So I'm going to flip the sign, so equals negative sign, the depreciation number that was used above. Then, for simplicity's sake, to calculate capital expenditures, we're going to say that it's equal to tax depreciation, as you can see right here. This is just an assumption we've made, so I'm going to type Alt equals negative and press Enter to get that. And then we've provided this number, the change in working capital. That's based on some balance sheet adjustments, and we cover that in detail in more advanced courses. But for now, it's not a huge number. It doesn't net out to make much difference, but we've given it to you to build this model together. And then the unlevered free cash flow is simply the sum of the NOPAT, the D&A that's added back, the CapEx that's deducted, and the working capital changes. So I can copy these numbers here and then select across and paste these as formulas, Alt ESF. And same thing here, copy. I hold down Shift while I'm pressing the over arrow, Alt ESF for formulas. The reason I paste this way, paste specialist formulas, is to preserve the formatting. You can see that the formatting here has like a special border around it and some underlining and stuff, and I don't want those numbers to get messed up or that formatting to get messed up. So here's my unlevered free cash flow. I started with EBIT, just as I outlined in the slides earlier, deducted taxes, that gave me NOPAT, net operating profit after tax, added back D&A, deducted CapEx, and then adjusted for the changes in working capital. So what I can do down here, let's just fill this in together, is first of all, reference the unlevered free cash flow in year 1 of my forecast, copy that, and paste as formulas. This gives me the unlevered free cash flow for every year. And then I'm going to reference EBITDA, which is contained up in the income statement here. You can see the terminal period EBITDA that I'm going to reference there. And that's going to be used for my terminal value. So let's link one more time the discrete forecast period, unlevered free cash flow. I'm bringing it down here so that we can calculate the net present value all in one spot. For terminal value, we put 0 in each of these years because there's no terminal value until the end. To calculate it in the end, I just take the EBITDA. And since I'm going to use the exit multiple approach, I multiply it by the terminal value multiple of 8 times. And as you can see, it's a really big number because if we sell the company, we're going to get all the future value for it. So what we can do down here is sum up with Alt equals these 2 sets of cash flows, fill it in with pasting special. And you can see here the total cash flow of the discrete forecast and the terminal value. Okay, now let's calculate the present value of the discrete forecast period equals NPV, reference the discount rate, comma, and then select each of these cash flows that make up the discrete forecast period. Close bracket and press enter. So you can see that number here. And then let's calculate equals NPV, reference the discount rate, comma. Here we're going to select This is another way to do it. Instead of selecting each of the individual years, we'll just select the whole series, close bracket and press enter. And we can see the net present value. All right, so now we can see our enterprise value here, which is the sum of two parts, the discrete forecast and the terminal value. I've shown you two different ways to use the function. You can select each cell individually, or you can select the range. Both work to get the enterprise value. And then what we're going to do down here is calculate the equity value, which simply subtracts the net debt from the enterprise value. Since it's unlevered free cash flow, we get enterprise value when we use NPV, and then we have to adjust for net debt to get equity value. And then once we have that, we can calculate the equity value per share by dividing the equity value by the number of shares outstanding.